So we finally come to the third part of cash flow, that is cash flow from financing activities. Now, as we have discussed, there are two ways of financing a business: debt and equity. So, in cash flow from financing activities, we are basically breaking our cash flow into cash flow from debt and cash flow to debt. That is cash flow which is received by taking debt, and cash flow which reduce by paying debt, and cash flow from equity, that is cash flows which are received by issuing equity shares, and cash flow to equity, that is cash that is paid back to equity shareholders by paying what? By paying dividend and buyback. So, coming up to cash flow from or to debt, if let's say your company has plans to reduce debt, so what will happen? You can expect that the cash flow from debt will be negative, and if your company issues debt, then cash flow from debt will be positive. Similarly, cash flow from equity and to equity, if your company is paying dividends to equity, it will be cash outflow for the company. If the company is buying back its shares from the equity shareholders, it will be outflow for the company as the cash leaves the company. And if the company issues shares, equity shares, it will be cash inflow for the company. So this is how cash flow from financing activity looks like. Debt issued, it will increase your cash flow, so it's a plus item. Debt repaid, it will reduce your cash flow, it's a minus item. So that is basically represent cash received and paid to debt. If you issue equity shares, it will increase your cash flows. If you pay dividend to equity shares, it will reduce your cash flows, it's a minus. If you buy back equity shares, it's a minus to the cash flows. And that is how you get cash flows from investing activities. It is one of the simplest cash flows to understand. Now going back to our tradition, let's see the cash flow from financing activities of Apple and Amazon. Here we have the cash flow of financing activities from Google, Alphabet. We had seen that the cash flow from operating was 91 billion. The cash flow from investing was 35 billion. So what happened to the rest? Well, Google had basically paid $10 billion of what? They have basically net payments related to stock-based award activities. What does this mean? This was not written in our format. So this basically means that Google has issued ESOPs or stock-based awards. ESOP means employee stock options plans to its employees or its key persons, and they have given this stock effectively free of cost. So that is why this figure is being shown in financing activities, because Google has given something free of cost for something which has huge market value. They have repurchases of common and capital stock. This basically is a fancy word for buyback. So they have basically buyback from equity shareholders, and this has resulted in $50 billion of cash outflow. So you can see here the majority of cash which was remaining after investing, majority of it has been used in stock buyback. They have issued debt net of cost. So they have issued $20 billion of debt during the year, but they have repaid more than which we have issued, and that is $21 billion. So effectively they have paid their debt during the year. And they have sold some of the shares in few of their consolidated entities, that is some joint ventures which they were having, of around $310 million. So all of this has effectively resulted in around $61 billion of financing activities cash flows. And you will see this same theme in almost all the common FANG stocks. Why is that? Well, the reason for that is because these companies are making so much profits and they have so much high cash flows. They do not know what to do of these cash flows. Why? Because the fixed income securities or the government securities yield a very small amount. So these companies are effectively doing majority of dividends and stock buybacks to improve their return on equity. How return on equity is improved when you're doing buyback? That is for another chapter. But right now just understand that what usually you will see in big FANG companies, there will be huge operating activities cash flow. Some amount will be used in investing, but the majority of cash flows will go to share buyback, that is repurchases, or the majority will be used for dividends. And effectively, this is how you can see the entire cash flow of Google. It earned $91 billion of operating cash flows. Out of that, it effectively used $26 billion for capex or for its growth. The remaining amount, some of it, about $7 billion, was put in for marketable securities like your mutual funds, your government securities, your 10-year bonds, etc. And the majority of the cash flow, almost $60 billion, was used to repay, first of all, your equity shareholders through stock buyback and through rewarding your long-term employees by giving employee stock option plans, because Google earned majority of its revenue through the back of its genius engineers. So this is how they basically repay them and retain them, by giving them huge stock ESOPs. So let's see the cash flow from financing activities of Amazon. Now, Amazon had $66 billion of operating cash flows, out of which around $42 billion were used for capital expenditure by purchase of equipments and by making acquisitions of around $2 billion. So $42 billion were used for that, and around $22 billion were used for marketable securities investments, right? As we can see here. Now, what has happened in financing activities? Well, Amazon has issued short-term debt, but it had repaid short-term debt also, resulting in almost around $500 million in increase in short-term debt, because proceeds exceeds the repayment by around $500 million. They have received long-term debt of $10 billion, but again, they have repaid long-term debt, and they have repaid leases, and they have repaid financial leases. Financial leases are just another way of long-term debt. So effectively, you can see majority of amount of Amazon was actually used in purchase of marketable securities, and they have not made any dividends or buybacks to their investors. Effectively, the net cash flow from financing activities is only $1 billion. I say only because we are dealing with $66 billion of operating cash flows. Let's take a new company to understand cash flow from financing activities. Now, this is a company called ITC in India. This is the biggest cigarette brand of India, and it basically is a cash cow machine. It earns majority of its income by selling cigarettes in India. Now look what happens in ITC. We have operating activities, we have investing activities. The net cash flow, they have earned income in 2021 of 17,938 crores. Out of that, because they had paid the income tax of around 4,386 crores. This had resulted in net cash from operating activities of around 12,000 crores. Out of this, they have just invested 5,700 crores in investing activities, out of which majority of which are actually mutual fund investments. So what are they doing? They are basically, so let's conclude the cash flow from investing activities by looking at a company called ITC. Now, ITC is the biggest cigarette company in India. It is a cash cow machine which generates huge amount of operating cash flows, and all of these cash flows are basically used in financing activities. Let's look at the cash flow statement to understand how. The cash flow from operating activities is around 12,000 crores. The investing activities, they have generated cash inflow, because it is a plus sign, of around 5,600 crores. And see what happened in the financing activities. We have some share capital of 290 crores have been issued, some lease liabilities have been paid, some interests have been paid. But look where the majority of the cash flows have been used. Almost all the cash flows of operating and investing activities have been used in paying dividend to its shareholders. Do you know what it tells me about the company? It tells me that company is actually not growing too much. Actually, the company is just giving back whatever it is earning back to its shareholders, because it doesn't have too much avenues for growth in cigarette industry right now. Since cigarettes are a toxic word, are a banned word in ECG investing. So this is how the company is rewarding its shareholders. Company is earning huge amount by selling cigarettes, and all the amount is being given back to its shareholders. So this is how, by looking at a cash flow statement of a company or of a business, you can see how effectively you are managing your business, how effectively you are putting your money back into the company for future growth, and what is happening to the rest of the amount. Are you taking it out of the business and you are paying it to equity shareholders, or you have to pay to the debt holders? I will argue that cash flow statement, in my opinion, is the most important statement for any entrepreneur or businessman to know. It really tells you and it really makes you understand what is actually happening in your business. We think, have you heard the saying? Follow the money. And this is exactly what cash flow statement does. It helps you follow the money and see what is exactly happening in your company. In fact, one of the ways we value company in real world is we do two things. We do what? We take these operating activities cash flows and we reduce them by just two things. What are the two things? The capital expenditure in operating assets and the acquisitions made. And that is how I basically value the companies. The companies are valued not based on their profits. So if I want to value Google, or if I want to value my own business, I will not just look at the net income. What I will actually do is I will look at the operating activities, that is $91 billion. And out of these operating activities, I will reduce the capital expenditure made during the year of $24 billion and $2.8 billion. And the net amount is what I will take my real cash flows or the real earnings of the company. This is an extremely high level concept in finance which many people don't understand. That is why we say profits and cash flows are two very different things. And in reality, it is cash flows that matters, not profits.